Hey there. Welcome back to Asset Zenith, the place where smart money habits meet long-term investing wisdom. I'm glad you're here. Now, let me ask you a question. Have you ever sold an investment too soon just because the market dipped and it made your stomach turn? Or maybe you jumped into something because everyone else was doing it, and it felt exciting in the moment? Yeah, we've all been there. Today we're talking about something a little different. Not charts, not interest rates, not stock tips. We're diving into your mind. That's right, the psychology of investing. Because if there's one thing that can make or break your success as an investor, it's not just what you invest in, it's how you handle your own emotions. So grab a cup of coffee, settle in, and let's explore how to overcome fear, greed, and all the emotions in between, so you can make better, smarter decisions with your money. The real challenge, it's not just the market, it's you. Here's a little secret. The stock market isn't your biggest threat. Your brain is. You see, humans weren't designed to invest. We were designed to survive, to run from danger, to react fast, and to seek reward. That was useful when our ancestors were avoiding saber-toothed tigers. But in today's world of investing, those same instincts can backfire. Big time. When the market drops suddenly, your brain screams, "Get out now!" When a stock is going up fast, your brain whispers, "Don't miss out!" And when everyone else is making moves, you start wondering if you should too, even if it doesn't make sense. That's the tricky part. Investing is emotional, but successful investing requires emotional control. So let's look at the most common emotional traps investors fall into, and what you can do to stay one step ahead of them. Common emotional traps investors fall into. First up, fear. Fear is a powerful emotion. It kicks in when the market starts falling and suddenly all you want to do is protect what you have. Panic sets in. The news is full of scary headlines, and before you know it, you're selling off your investments just to stop the pain. But here's the thing. Fear makes us forget that markets are designed to go up and down. History shows us that recoveries often follow crashes, and the people who stay invested usually come out ahead. Then there's greed. It's the opposite of fear, but just as dangerous. Greed shows up when the market's booming. Stocks are climbing, your portfolio's growing, and you start thinking, maybe I should put more in. Maybe this time is different. But greed clouds judgment. It makes you take bigger risks than you normally would. And often, just when things feel safest, that's when the market corrects itself. Let's not forget FOMO, the fear of missing out. When a hot stock or crypto coin is all over social media and your friends are bragging about their gains, it's tempting to jump in, even if you don't understand what you're investing in. We've seen it with meme stocks, NFTs, even tulips back in the 1600s. Yes, tulips. In every generation, there's a trend that pulls people in emotionally, only to leave many of them holding the bag. Then there's overconfidence. This one's sneaky. Let's say you made a few good calls. Your investments are doing well. You start thinking, I've got this figured out. That confidence can lead to bigger, riskier bets. You stop doing your research. You assume you can't lose. But markets have a way of humbling us, fast. And finally, loss aversion. We humans feel the pain of loss twice as strongly as the joy of gain. So when something goes down in value, we tend to hold on, hoping it'll bounce back. Or worse, we refuse to invest at all because we're still haunted by a past mistake. But fear of loss can keep us stuck. And staying stuck is often the most expensive decision of all. Why we feel this way. A peek inside the brain. So why does all this happen? Why do we make emotional choices, even when we know better? It's actually hardwired. Inside your brain is a part called the amygdala. It's responsible for detecting threats and triggering the fight or flight response. When the market drops and your portfolio takes a hit, the amygdala kicks in, treating it like a life or death situation. Meanwhile, When you score a gain or hear about other people making big money, the brain releases dopamine, the same chemical linked to pleasure and reward. That's why you get a rush when your stocks are up, and it's why investing can feel a little addictive. But the part of your brain that handles logic and long-term thinking, that's the prefrontal cortex. It works slower, and when emotions take over, logic often gets shoved to the side. That's the challenge. But the good news, once you understand how your brain works, you can start working with it, not against it. Real-world lessons, when emotions took over, and when logic won. Let's look at some real-life moments that show what happens when emotion leads, and when it doesn't. In 2008, the housing market crashed. Panic swept through Wall Street and Main Street. People lost jobs. Portfolios sank. Many investors pulled out of the market completely. But those who stayed the course, who kept investing or even bought more during the dip, saw huge gains in the years that followed. In early 2020, during the COVID-19 outbreak, the stock market fell over 30% in a matter of weeks. Fear was everywhere, but once again, the recovery was fast. Investors who stayed calm saw their portfolios bounce back stronger than ever. On the flip side, think about the dot-com bubble in the late 90s. The internet was booming. Stocks were soaring. People invested without doing research, caught up in the excitement. When the bubble burst, it wiped out trillions. These moments remind us that emotions can be costly, but staying calm, steady, and focused on the long game, that's where real wealth is built. How to stay emotionally resilient as an investor. All right, so how do we take all this knowledge and actually apply it? How do we stop emotions from hijacking our financial future? Here are some simple, powerful habits you can build. 1. Have a plan. Start with your goals. What are you investing for? Retirement? A house? Financial freedom. Once you know your destination, it's easier to ignore distractions and stay the course. 2. Automate your investments. Set up automatic contributions to your retirement or brokerage account. That way you're investing consistently. No matter what the market is doing, it takes the emotion out of timing. 3. Diversify. Don't put all your eggs in one basket. Spread your investments across different assets. Stocks, bonds, ETFs, even real estate if you can. Diversification helps smooth the ride and reduce emotional shocks. 4. Use dollar-cost averaging. Instead of trying to buy low, just invest a fixed amount regularly. You'll end up buying more shares when prices are low and fewer when they're high, naturally. 5. Limit how often you check your portfolio. The more you look, the more you'll feel. And the more you feel, the more likely you are to act on impulse. Try checking your portfolio once a month, or even once a quarter. 6. Keep a journal. Before making any big investing move, write down your reasoning. Later, revisit it. Over time, you'll start to spot emotional patterns and learn from them. 7. Learn to pause. If you feel a strong urge to buy or sell, take a 24-hour pause. Emotions fade with time. Logic returns. A quick decision made in panic can become a regret, but a decision made calmly? That's usually the better one. At the end of the day, investing is a test, not just of strategy, but of character. The market will challenge you. It will tempt you. It will scare you. But if you can learn to recognize your emotions, to sit with them, not act on them, you'll unlock something powerful. Because building wealth isn't about being perfect. It's about being consistent. It's about having a plan, sticking to it, and trusting the process even when it feels uncomfortable. And here's the beautiful part. Every time you resist the urge to panic, every time you choose discipline over emotion, you're not just becoming a better investor. You're becoming a better version of yourself. So, if today's video gave you some clarity, some peace of mind, or even just a new way of looking at your money, go ahead and hit that like button. And if you haven't subscribed to Asset Zenith yet, Now's the perfect time. We're here to help you think smarter, invest wiser, and grow wealth that lasts. Thanks for hanging out with me today. Stay calm, stay curious, and most of all, stay invested. I'll see you in the next video.